Welcome to Corporate Finance. Welcome to Introduction to Corporate Finance. My name is Greg Pierce, finance coach, and we're here to talk about everything finance. Our book that we're using is the best textbook, number one textbook in the U.S. for both undergrad and graduate in the area of corporate finance, and that is Ross Westerfield and Jordan's Fundamentals of Corporate Finance. Our course is broken down into four key topical areas from 30,000 feet. We're going to first talk about financial decision-making and how do we make effective decisions in the financial world, both on a business basis, corporate basis, and on a personal basis. We'll talk about things like income statements and balance sheets and cash flows and how to common size these statements. We'll talk about ratio analysis and how we can make effective decisions using ratios. Then we'll go into a session on budgeting and forecasting, which you'll spend much of your lives doing if you decide to work in a corporation. Then our second key topical area is valuation of future cash flows. Here we'll talk about why a dollar today is not worth the same as a dollar tomorrow. We'll play some games like Who Wants to Be a Millionaire and what must I deposit today in a lump sum to have $1 million at, say, 10% interest rate in the next 44 years by the time I turn 65. And then we'll also answer the question, can I do it incrementally each and every year, have a little deposit versus one big lump sum at the beginning of the session. Then we'll move on to a third key topical area, financial markets and institutions. We'll look at things like stocks and bonds and where do we buy these instruments? What are the financial markets that are out there for us? Also, how to value a bond. It's a fixed income security. And how much does a bond cost typically? What does a typical corporate bond cost? And where do we buy them? And also stock valuation. We'll look at several ways to value stocks and how do we do that effectively. And we'll look at topics like dividends and dividend yield. In this, we'll study the New York Stock Exchange and the NASDAQ and other financial markets like cryptocurrencies. Where do we buy our cryptos? Should we be interested in investing in this new area? Finally, the fourth key topical area is investments. We'll look at investments, major capital investments, like if we're going to build a large steel plant or a large car manufacturing facility. How much does it cost, and how do we make good decisions on those large investments? Topics like net present value, internal rate of return, break-even analysis. We'll do all of that in this key topical area called investments. So welcome to Corporate Finance again. My name is Greg Pierce, finance coach, and we're going to look at these key areas. And hopefully you'll learn them well so that you can use these topics effectively in both your business life and in your personal life. Each chapter will have a roadmap like this with the key learning objectives. First, in session one, we're going to talk about what is corporate finance and what's on the mind of the financial manager each and every day. Capital budgeting, capital structure, networking capital are three key areas of interest here. Then we'll move to forms of business organization. And should I start a new business, what kind of form can I take? We'll look at sole proprietorship. We'll look at partnerships. We'll look at corporation and the various attributes of each of those key forms of business organization. Even one of the newer forms, LLCs. Third, in session one, we'll look at the overall goal of financial management. What is that? Simply to maximize market value per share of existing stock when we go into work every day. The fourth key learning objective in this session is the agency problem. Can I get into an agency problem both in my life as a student and as my life as a leader of my corporation? Who controls the corporation? We'll address that also. And finally, we'll look at financial markets in session one and how do these financial markets interact with the corporation. What's corporate finance all about? Apple Inc., used to be known as Apple Computer, was started in that house out in Los Altos, California, and three young men started it: Steve Jobs, Steve Wozniak, Ronald Wayne. Sales grew very, very rapidly because it was kind of a new type of invention. The Apple I, the Apple II, the Apple IIe, and the Macintosh used heavily in the education. That E standing for education back in the day. In the education market, the Apple products were used heavily. Not so much in corporations to begin with at the very beginning, but eventually they caught on. So around 1976 in Los Altos, in that house, that is Steve Jobs' parents' house, basically in the garage, started in the garage operation, and those three fellows were the founders. Grew fairly rapidly. In 85, there's an industry-wide sales slump. IBM started to enter the market at that time. I got my first IBM PC at that time. In 1985, I grabbed it quickly as I could, because I thought I could do some forecasting and budgeting on spreadsheets. And I didn't really even know what a spreadsheet was at that time, but I grabbed it fairly quickly, and it paid off handsomely. Steve Jobs was ultimately fired in this industry-wide slump, and it was his baby. Kind of unfortunate, kind of tough. I'm sure he took it personally, but basically the board of directors fired him of the company he founded. He went on at that time to found two other companies. Not to waste any time, he founded Next right away, and then finally Pixar, which you're all familiar with. Next Computer was a engineering workstation operation, and Pixar obviously animated movies, which have been very, very successful, and you've seen many of those films that his team produced. Jobs was worth about $120 million at the time. When he was fired, Apple was worth about $1 billion at the time. Basically taking the number of shares outstanding times the stock price at the time. So Jobs was out running two other companies. Apple needed him back desperately. Apple was really suffering at the time after Jobs left the company. And so to get him back, they bought Next. And also did some good things for Steve, gave him some stock options, and a Gulfstream jet to travel between his other two companies and Apple headquarters. Today, Apple's one of the most valuable companies in America and the world, exceeding $1 trillion, not billion, but $1 trillion in market value. And this company has done very, very well over the years, and it's a very interesting story, which touches on many of the concepts that we go over in this session. What are the key questions asked in corporate finance? These deal around capital budgeting, capital structure, and net working capital management. Now, question number one, what is capital budgeting? What long-term investments should I take on? What is capital structure? Where am I going to get the money to pay for those long-term investments? Typically property, plant, and equipment. And capital structure deals with debt and equity. And working capital management, you all know from prior classes in accounting or finance that working capital is current assets minus current liabilities. And basically, how do we manage our everyday financial activities? Very, very important, and we'll go over that in some detail. Capital budgeting is basically what I suggested. It's property, plant, and equipment. We want to look at the firm's long-term investments, fixed assets, which ones should we take on, and will they be more valuable than the cost of taking them on? Property, plant, and equipment. When we talk about capital budgeting, that's what we're talking about. As you know, these are items that get listed on the balance sheet, which we'll talk about in session 2. PP&E, you may hear it called PP&E. When we're discussing that, we're talking about capital budgeting. This is one of the 3 questions that's on the finance manager's mind every day. So remember that when we talk about capital budgeting, those are kind of fancy words for looking at property, plant, and equipment. An example on the Penn State campus might be the new Pagula Ice Arena, which cost just over $100 million. Some major property, plant, and equipment, a beautiful facility. So it's a wonderful, wonderful opportunity for our student athletes to be able to play in that brand new facility. I want to look at investing opportunities where the cash flow generated by these assets is greater than the cost of the assets. And if I'm doing that, I'm doing a good job at capital budgeting. An example used in the text is opening a new Walmart store. So down in Bentonville, Arkansas, an example of capital budgeting will be, do we need another Walmart store in State College, Pennsylvania? How about another Sam's Club? That would be some capital budgeting discussions that might go on in Bentonville, Arkansas. Another example might be a software package like an update to Windows, Snow Leopard operating system on the Apple platform. Those are also examples of capital budgeting. Capital structure is the second question on the mind of the financial manager. Where are we going to get the resources, the money, the funding to pay for that property, plant, and equipment? Well, there are several sources. We could go the debt route. We could go the equity route. When we talk about debt and equity, we're talking about securities. And we're also talking about capital structure. What is our capital structure in our company in the form of debt? Are we going to take on bonds, or are we going to take on loans? So when we talk about debt, we typically talk about those two things. Equity, when we mention the word equity, we're talking about funding items via stock issue. How should we run our daily financial activities? Is the third question on the mind of the financial manager. And we're talking about short-term assets and short-term liabilities or working capital. When we take the difference of the two from the balance sheet, current assets minus any current liabilities we have in the short term, that's known as net working capital. Remember that equation. It's fundamental in both accounting and finance and very, very important. These items are all three found on the balance sheet. The items on the balance sheet are listed in order of decreasing liquidity. So the most liquid things are at the top and the less liquid things are further down the balance sheet. So under current assets, we have cash as the most liquid of all current assets, accounts receivable, which are a little bit more difficult to turn into cash, inventory, and prepaid assets. Prepaid asset example might be a subscription. Let's say you own a doctor's office and you have a subscription to Sports Illustrated, and it's only June, so you have half a year left on your subscription. That's a prepaid asset. You paid for the whole thing at the end of last year, and you have a whole year paid in advance. Current liabilities are also listed on the balance sheet in order of decreasing liquidity, accounts payable, things I owe. What I own is on the left, current assets. What I owe is on the right, current liabilities. Things like accounts payable, notes payable, wages payable, interest payable, taxes payable. Our authors like to think of those things payable within the coming year. My personal life, I take accounts payable pretty seriously. I want to pay them this month. So if I have a credit card bill payable, I want to pay that thing right away. Current assets divided by current liabilities is what's known as the current ratio. What is a good current ratio? I like to use something like at least 2-to-1. Others may argue that's tying up too much of your current assets, so you get into some debates on those matters, but I am very comfortable having twice as much of my current assets available to pay my current liabilities, whether it be on a personal basis or a corporate basis. What's the overall role of financial manager? So you'll see in this chart what's known as an organization chart of where the financial manager sits in the hierarchy below the board of directors, below the chairman and CEO, below the president and COO. You'll see a VP of finance, CFO, VP of marketing, and VP of production. Under the VP of finance, you have a treasurer and a controller. What does a treasurer do all day? Worries about cash, four-letter word, cash. Also thinks about credit. Should we offer credit? And some other things may be thrown the way of the treasurer. The controller basically controls. What does a controller control? Taxes, cash, financial accounting, data processing. I'd probably move that out under a VP of IT these days. I wouldn't put it under the controller to avoid any conflicts of interest. Here's a quick quiz. Check for understanding. What are the three types of financial management decisions? What's on the mind of the financial manager every day? Capital budgeting, capital structure, and net working capital. Things that you worry about and think about all day long. In a large corporation, what are the two distinct groups that report to the CFO, Chief Financial Officer, the treasurer, and the controller?